Hi everybody, Eddie here. Going to do a market update for next week. It's been a fairly bearish week. We had that really big bounce over here to retry that 4200, and then we sold off towards the end of the week. But on Friday we did held the 21-day moving average. We came down, we retested, and then it held at the 4060 area, and then it bounced back up. It's right in between the 8 and 21 right now. So for next week, you want to see this break higher and retest around that 4200 area to go higher. If it doesn't mix a high, like a lower high, get rejected somewhere around that 8 EMA again, it's likely that we'll come back down and retest the 4000 area. So this is a very important area. Anything above say 3900 is still okay. It can still go higher from there because it will still consider higher low. But anything below that, it's back in bear territory again. So if it falls below that 200-day moving average, then we're back in bear territory. So historically, February around the start of the third week, it does tend to pull back quite a bit. So it tends to pull back into March, and then it goes back up in April. So, if it does come back, it might have just come back to retest this 200 and then bounce higher off that and then continue higher to make the to fill this gap and go back and maybe test this 4300 or even go higher towards the end of the year. All right. So right now we're still in trend. It's still bullish technically. If you can see, this is the channel right here. We're still in the channel. So there's really nothing to worry about just yet. We are seeing some early signs of the momentum start slowing down and possibly come back and retest this box down here. So if it does, don't be surprised. Right over here is where you want to see it to hold. And if it does hold and then start bouncing off this level, this will be a good area to start buying stocks again. Right. So for now, just be more cautious. See how it goes. If we actually bounce and actually break above the 8 EMA again, then we could possibly see higher highs. But just because of seasonality wise, I think we're either going to come back down or we're going to chop around for the next month or so, right? So let's take a look at the Qs. Same thing with the Qs. Qs are broken out and then retested, and then we're in between that area again. So whenever the EMAs get a little bit wide, you tend to want to be more cautious because that's usually when the markets start pulling back down, and it does seem to look like that at the moment. So techs had a really, really strong rally up. And a lot of retailers are back in the markets. So whenever there's extreme buying from retail investors, usually there tends to be a pullback around that time. That's when you know that the move is getting exhausted and start pulling back because we're at extreme greed and it needs to pull back um, and then pull back and find some support and then continue higher from there. Right. So for the Q, same thing. You're looking around this 200-day moving average here. As long as you can hold above 280, you're fine. It's best if you just chop around right here, form like somewhat of a triangle, and then continue higher. So I'm looking at something like this to form. Something like this to form, come back to around here, and then, pull back, chop around, and then go higher, right? So if that's the case, then, it could end up to be a really good year. So if February holds, it's likely that we're going to have a bullish year. So as long as it stays above the 200-day moving average, you should be fine. Okay, so take a look at the VIX. VIX are starting to start crawling back up again. So we're above 20 at the moment. So right here, you can see last week we talked about the VIX being around this area where it tends to bounce. So we're starting to bounce right now. The moving averages are starting to get stacked together. So do prepare for some volatility. So if we get like the next 2 weeks, we get a down move on the S&P 500, it's likely that the VIX will start crawling back up to around that 25. And then if it really gets a strong sell-off, you can go back up to like 30, 35 area, right? So just pay close attention to that. Watch how the VIX moves. If it stays below 25, it should be okay. Could just be a healthy pullback. If it goes anything above, then you want to be a little bit more careful. All right, so let's take a look at Apple. Apple had a really strong rally off the bottom of that range at that high demand area right here. So we highlight that. We talked about this level before. So this is the area it bounced hard off, and then it's back above the 200-day moving average again. So you want to see it hold above this channel and then continue higher. My target really is just around that 165, 170 area. So if it actually holds well, and then if the market actually cooperates, we can see these highs right here. But for now, the likely scenario is it will actually pull back. Usually, the first wave it pulls back about 50%. So you're looking around that 140 area. So if it pulls back to around that 140 area, you want to see if it'll hold around here, and if it does, then that would be the good area to start buying again. Okay, AMD. So AMD is making higher highs and higher lows off this low right here. So you can see there's the low, there's the higher low, there's the high, there's the higher high, right? And now we'll start pulling back. So you want to see it to hold above 75 and create another higher low and then continue higher. So it does look like it's trying to form a bottom right here. But you want to pay very close attention to this area right here. So if this pulls back further than $60, it's gone. It's going to go make a more of a lower low type of thing, right? Because if you look at this in a bigger time frame, this does look like some sort of shoulder forming right here, and then you can come all the way back down, right? But hopefully this is just an area where it's going to consolidate and then continue higher from there on AMD. But if it does come down to about that 60, 65 area, I would start buying some. Get your first leg or two in there, and then save your other two legs down at the lower range if it does break down. That's how you can trade it for longer term. Shorter term, just follow the EMAs. Just follow the momentum, and you can go in and out of the stock if you like. That's the way I usually trade. But if you're looking for longer term, you can start selling some puts around that $70, $60 area. Put your first two legs in, and then if it drops down to like 30, you can add on to it. So Amazon, it pulled all the way back down to this demand level right here. So you want to see Amazon to actually hold above this area. It's still in a very defined downtrend. So as you can see, we pop up on earnings, hit the 200-day, got rejected hard off that level, and then we came all the way back down. So you want to see this stay above $80. If it does lose $80, it's likely it's going to continue down and hit 70, and 70 is the support area. So like between the 65, 70 area, if it doesn't hold right here, it can drop pretty hard down to 40. But like anywhere below 80, it's a buy for me on Amazon. So if you wait till he pulls back a little bit, and you can start selling some puts and grab some shares if you want. So if he pulls back to around $90, I can start selling some puts probably for $85, $80. You grab some shares over there. And then if it does drop down to 85, 80, I'll be selling another set of puts around that 70, grab more shares. That way I can accumulate a position for longer term. And then once the market bottoms, it can go back up again. All right. Meta. So Meta it jumped all the way up and is now back into the gap. So I'm looking for a gap play right here where you can short from 174 all the way down to the gap fill right here at around that 153 area. So you look at moving averages pretty far apart. So it is extended and it does need a pullback. So coming back and retesting this breakout area is very likely, and it could be a fairly good play. The way to play, I would probably sell like a credit spread somewhere around a call bear credit spread around that 190, 200 area. If you're more aggressive, you can sell them right at the money and then see if you'll gap filled right there. So Google had two really strong sell-off days because their AI bot, chat bot, actually made a mistake on their answer. So people took that as an excuse to sell it off, but actually GPT is also not that accurate on some stuff. So it's nothing new. They're at the beginning stages. So I'm sure Google will find something and make it way better than Chat GPT later on. So this sell-off could be an opportunity. I'm looking forward to grab some shares around like that 85.90 area. So if he does pull back into that area, I'll be start buying some stocks. So even right here, I probably can sell some puts around that 85 areas for like the next 2 months and see if I could grab some shares. If not, I'll just take the income. Right. So that's the way to play it. I mean, if you're happy with owning Google at these areas, I mean I would. It's trying to make a base over here is trading in the range, right? So if it's in the low range, it's a good buy. If it's in the upper range, you could trim some and then just create a precision over time. And for this strategy, use options to your advantage. You can sell credit spreads. You could grab some shares and then sell like strangles around it to grab some income and stuff like that. There's a lot of like neat stuff you can do with options when it's going sideways like this. So take advantage of it. I mean, Google is a good stock. So even if you grab the shares at this price range, I mean, longer term, you're gonna make money. So it really does not matter that much if your strategy does not work out temporary, right? So what I would do right here is I would sell some puts for strikes down here. Take the shares if it does come down, right? Sell short-term puts until you grab the shares, right? That way you can, if it stays above it, you can just keep pocketing that income. And then if it does come down, you grab the shares and then you sell your strangle around those shares and grab even more premium, right? And then also create your next layer down, probably around $80 or $70 will be the next range to come down to. So I would work that out in your trading plan and have different layers to go into the stock at different strike prices using options as a way to get the shares. That way, it reduce your costs, and you also get the shares that price you want it at, right? In worst case scenarios, is you don't get the shares and then you collect the premium. So that's a good way to play it. Microsoft. So Microsoft has this like double bomb cup and handle thing going on. It is still holding strong right here above the 8. It is one of the better names at the moment to buy. There's the discount is still there, but it's just not as steep as the other FANG names. So Microsoft's the second strongest name behind Apple. So it's if you really want to grab some shares, sell some puts around that 250 area to grab the shares for your first leg. Anything above 200 is good for the first leg, and then if it does come down, you get them lower. But for now, my bias for this year is actually bullish, right? Because it's third year into election year is usually the most bullish year as well. And as well, from historic facts, if you have a strong January after a very bearish year, the year actually ends up pretty green at the year after. So this year I'm very optimistic. And I am looking for pullbacks on these stocks to actually start grabbing shares because I actually did not grab that much shares. I bought some a couple weeks ago, but they're very small, right? It's only my first leg into it. yeah, I'm looking to get into my second leg and actually start building a position in case this is the bottom. And if this is the bottom and we're actually going to have a really strong year, then I don't really want to miss out as well. So you want to be very smart on how you precision your trades, right? I mean, if it does go up, you can always average up into the trade, but I prefer averaging lower prices, right? Knowing that we're going to probably come out of this thing in the next year or two. So let's take a look at Netflix. So Netflix is almost hitting that strong resistance around that 400. So it is pulling back. I'm looking forward to pull back to around that 325, 320, 325 to see if it hold. If it does hold around 320, 325, that's a good area to sell maybe a credit spread or yeah, that's the only way I would play Netflix is that credit spread. I really don't trade the stock that often. It's one of the stocks that I don't like to trade for some reason. Mostly probably because they're not that profitable company and there's a lot of competition. So it's more negative impact in the longer term than it is positive. So I only like to trade it with short time frame. I don't like to hold on to this stock. So that's the way I always look at it. If I am going to trade this now, I would sell like a credit spread, like bear call credit spread right here for maybe a week or two, and then if it comes down and it got holds right here, I would close off the credit spread, and then I'll maybe start selling some put credit spreads and play the other way around if it continues higher. So that's the way I would play it if I am going to play Netflix. Nvidia is overextended, right? So we're way overextended right now. I'm looking for a higher low for it to come back. So yeah, it's around 100%. So I'm looking for it to come back somewhere along right here, 180, 190. 190 is probably a good area to get back into it if it actually holds 190. If it holds 190, it'll create like a higher low, and then we'll go for the next leg up. Next leg up could be pretty sharp and parabolic leg up because you can see right here, this is the area where it dropped down sharply. Usually when it dropped down sharply like this, on the way back up, it also goes up sharply, right? So you'll create some sort of like a cup and handle type of pattern. So we can see right here, it's coming down around bottom, and now we're on our way back up. So we're looking around target range around that 280, 290 area, and then possibly something like this and go back to test the highs, right? So this is a scenario. This is a heavy retail stock as well. So a lot of retailers love Nvidia, right? And they also love Tesla. So these are the two stocks when the markets are hot, people retailers like to throw the money at AI stuff. So this is a stock that you can ride the trend, but you have to keep very tight stops on these things because they do tend to fall really, really fast. So just use the EMAs as your guide and just follow until they break, right? So whenever it pulls back and you see the moving average get stacked together again and just go for another trade. Tesla is hitting that resistance area. We have a pretty strong pullback there. So it almost touched the 200-day moving average. It came back. It did held the 8-day moving average, right? So right here, it does kind of look like inverse head and shoulder type of pattern or a small cup and handle, whatever you like to call it. Right there it is right here. It's trying to form, so it needs to come down and hold this area right here, and then you'll form this, and then we could get a breakout to around that 250 to test this area right here. There's a gap that needs to fill right here, so that could be one of the targets as well. And then if it's really strong, it can come all the way back up to here, right? So markets tend to go in waves. So it's usually you'll come back, you'll go up, you'll come back, retest, and then go up higher, right? You get that last parabolic move, that's your exit, and then maybe you'll come all the way back down. Who knows? So that's the way to play it. So Tesla does kind of look like it is forming that type of pattern. So wait for a pullback. Likely you'll pull back around that 170 area. So that's a good area to maybe look to get back into it if it holds. If it does hold, get back into there, and then you can trade it back up to around that neckline right there. So the neckline is right around that $200 range, right? So it did like a little fake out right here. This is like an island. It's an island reversal. So these tend to be sharp reversals as well. So just pay very close attention what's going to happen next week. I think CPI comes out next week, so that's going to have a huge impact on how the market's going to move. If investors don't like the number of the CPI, it's likely we can pull all the way back down, and it's just going to drag everything back down. So that could be a big, huge impact on how the year could work out, and how this chart's going to work out. So if numbers are good, maybe we'll break out and then we retest up here and actually finally push through it. If it doesn't, it's like we'll come back and retest that 4,000 or even lower, that 3950 area. So that can very well happen. I think CPI is on Tuesday. The numbers come out, so pay very close attention what's happening on that day, right? If that day we break down, expect we're gonna go further down. My target right here for the short term is that 3950. If it doesn't hold 3950, we will lose this trend, and then it's going to start either chopping around or it's going to start flushing down a bit. So keep that in mind for next week, and be very careful on what you hold. Usually during the week seasonalities, I like to see pullbacks so I can get back into them for the stronger seasonalities. So, and that you could find some pretty good bargains in the next month or so. All right, let's take a look at the algo. Let's see. So for last week, the algo's been working pretty well on the trending days. So right here, this is a very bearish trend down there. If you caught the arrow on the 5-minute, you could caught a lot of these trades right here. So you got the big rundown right here, right on this trend right here, and then you get this big other rundown right here. The only time that was a bit tricky are these choppy days, right? These choppy days, I mean, you can scale, capture some decent moves if the waves are big enough. But when they go in the tight range, like right here in the tight range, you start seeing like these really choppy signals, and you don't make any money. So, you really have to learn how to trade with the aggro, because the aggro is for trend following. It's not meant for choppy days. When it's choppy days, what you do if you really want to trade it or scalp it, go into smaller time frames, right? So the 1-minute time frame, you capture some pretty good scalps like this move right here. And some of these moves right here, these are fairly good scalps, and this is during a choppy day, right? So all you have to do if you really want to trade it, go down in time frame, use, instead of using the 2-minute, 5-minute, maybe use the 1 minute. I like to use 15 seconds. So, if you're really good at trading, really has a very fast reaction, they use 15 seconds. But the majority of people, they like to use the 1-minute time frame, and you can capture some pretty decent moves using the 1 to 2 minute time frame on these tight little ranges right here. So, you just have to figure out what it is. If you're one of those people that like to follow trends, then during a choppy day, don't trade a trend. Don't trade, right? Because you most likely you won't be able to find a trend. And it's a good idea for you guys to learn some how to actually define a trending day and a choppy day. I do teach that in my course, my day trading course. It does help knowing what type of day it's going to be, right? And I do mention that in Discord as well. So in our Discord, I will say it's going to be a choppy day, or it looks like a choppy day, or looks like a trend following day, whatever, and the type of things that you should look for a type of day like that. So, the algo actually works really well if you stay in with the indicators, because they do tend to capture these really major moves when it's trending. So it also takes the emotions out if you actually just follow the algo itself, combine that with some technical analysis, and in some trading levels, and you've got yourself a really good strategy that you can use to make some consistent money. And that's pretty much the main thing here, is try to be consistent and find something that works with your personality. Because I could have 10 people trading the exact same thing and you have 10 different outcomes. Majority of it is because of the personality, mindset, and trading habits, right? So it's the type of things that really have to develop for yourself. Like, I could trade the same strategy. I teach the same strategy to 10 different people, and 10 different people have 10 different results. So um try to educate yourself, learn how to trade, and then stay consistent. If you're not consistent yet, start with small size or go on paper until you do, and then just work your way up and scale once you start becoming more profitable. Anyway, see you guys next week. Make sure to like, subscribe, and I'll talk to you guys later.